I mean, if you want to run down on gold, really it was under the funds were in the money managers were in the banks. They were all active sellers on gold. They were playing the rising yield curve. They were also playing the reflation trade. Stock market was continuing to move higher. We saw economic data really come out, and it was much better than expected. And that was really the true headwind for gold. And then as we started working our way up. Once you saw China start to slow down, they went into like a stagflation environment. That's when copper had peaked. It had started to come down from here. The Fed started talking about implementing tapering, starting to tighten up. You look at a lot of the other foreign central banks, they're not in a position to do that whatsoever. They're still being very accommodative. So you start to see the dollar index come up. You also start to see gold start to get some legs below it. We moved up. We took out 1800. There was a lot of, once you start getting in those zones of some of these round numbers, it becomes like gravity, pulls it up to 1800. It was very constructive. We held that level for several days. Then it was the big bad CPI report came out. The way we played it with a lot of clients was utilizing options. So we got a lot of leverage. We've been taken to the altar several times on gold where it gets up to that critical level and then it walks away from us. So we wanted to have some limited downside. We didn't want to see a $30, $40 downside day. Bought a lot of call spreads, January, February, April on gold. Gold shoots up, blasts off. We took off a lot on the implied volatility premium. So as it stands today, with the retail sales number coming out, retail sales has not been very friendly to gold whatsoever because it really shows a robust economy, which leads to more interest rate chatter, but a lot of that's already baked in the cake.
All right, Phil. Yeah, you're right. Interest rate expectations are on the upside or moving up towards the upside. But what about inflation expectations? We've had the highest inflation CPI print since 1990. And so real interest rates potentially could go down if inflation outpaces interest rates, nominal rates, that is, right? Is that possible?
Yeah, we could continue to see those real interest rates continue to grind lower. That would be extremely supportive for gold. It could start getting, gold futures back up over 1900. We did see some of the banks and some of them put out calls for $2,000. Little bit suspicious on some of those calls. I think a lot of times those guys are just trying to grab headlines by having that. So what is going to end up happening right now is that the growth curve is we've already had kind of peak growth in a lot of different areas of the economy. So that's starting to slow down month over month. Those numbers are going to come in. The yields are very flat right now. So the stagflation environment is going to do real well for gold coming up into the end of the year. And then as you go out into the first and second quarter of next year, that growth really stalls out. Yields really start to ramp up and it creates a deflationary environment, as well as the supply chain issues should be resolved. So if you have a lot more products out there, you're going to see the price of products come down. That's going to impact profitability on companies and prices will go deflationary. Gold acts as a good placeholder in your portfolio in deflationary environments.
Interesting. Okay, so 2 points there. First of all, you think that the inflation or the higher inflation level we've seen is not going to last forever. At some point, we will see deflation. And so the second point I want to bring up is whether or not gold performs well in a deflationary environment, gold and silver.
Well, gold acts as the placeholder and then in a lot of people's portfolios where they pivot from things like stocks to bonds to looking at things that are very defensive in nature. And then they also do hold quite a bit of gold at that point in time. So some of those input costs, if they start to come down, you'll see the miners should start to perform well with the higher gold prices and lower, like I said, costs and things like wages and fuel costs. And then silver, it's a bit tricky because it depends on what hat it wants to wear. Is it going to ride side by side with gold, or is this the period where we start to see gold outperform silver again? So I think you have to have some exposure to both. Remember, gold is a currency, so you take that exposure up to 10% in your portfolio. Silver is a commodity, and you really don't want to be more than like 4 to 6% because of the volatility. Okay. We did probe higher highs, but we are softer on this particular session. Like I said, retail sales has not been friendly for gold on any of the events that have come out that have been in positive territory, because it's showing that growth in the economy. So I really think that gold could go either way. We're taking it day by day. We do cover gold every day on a YouTube channel that I do, the Blue Line Metals Edge. So, if something breaks out, or if we take out the highs 1882, I think that gold can make that quick run to 1900. If we do break back below 1851, 1836 key level support, we go below there, the banks are going to come in, the funds will come in, and they will start shorting below that level.
Okay, interesting. They wouldn't buy at that level. They wouldn't see that as a buying opportunity.
No, because they'd start to see those yields go back up, and they know that the way that the metals work is that the volatility increases the implied volatility also on the options as it sells off. So a lot of times, on gold and silver, it's just the way it is. It becomes a panic, and everyone runs for the door when it starts to break down. So I don't think you get those diamond hands until you get closer to 1800 or anything below that.
Okay. Let's take a look at silver now. Sim story. Nice run in the last couple of months. Now, we're breaching $25, which is a key psychological level. Biden just signed into law the $1 trillion infrastructure bill yesterday. And with a news headline like that, you'd expect commodities, because you did differentiate gold and silver, with silver being a commodity. You should expect commodities to rally on that news, yet we're, again, like gold, silver is trading softly today. So what's your expectation for silver going into the future?
Critical level on silver, if you pull up a daily chart on it, it's about 24.92. It came up to that level in August, and then it just recently came up to that level back last month as well. So that is going to be your key level support. Copper, I think, is weighing on the price of silver right now. The problem with the infrastructure bill is that, it started off, it was like, $3.5 trillion, and then now we've winded it all the way down. So I think a lot of these higher prices were baked in. Now they're starting to come out. The devil will be in the details with it. Silver does have a nice trend line going up from those lows. We got to like 21.90 on the downside. We need to see constructive breakout, though. We need to see it close above 25.50. The next session needs to open up higher. That's the only way it could do it. And what you don't want to see, if you're a long option holder, is the average true range come in, the volatility aspect of it, because those options are going to lose a lot of premium.